Hey guys, this is a quick recording of the Wiley Plus assignment for Chapter 9. I think this one's relatively straightforward as far as the Wiley concerns. So the first question is a bond amortization. So we have a 10% bond, so it's going to pay interest at 10%. Maturity value 470, and the yield or the effective rate is 9%. Dated Jan 1, mature Jan 1. Interest receivable December 31 of each year, and we're going to use the effective interest rate method because that's the only one we're taking. Okay, so it's a bit long, but I think it's a good practice to go through the bond amortization. So first of all, the entry to record the bond purchase, that's always the same for all investments. I should have something called investment in bond, I think. Bond investment at amortized cost. And it's just whatever I paid. So 488, 280.65. And I assume I paid with cash. As I said, it's a long question. So that's the first part. That's the same for every investment. Then we want what's called a bond amortization schedule. So this is where we go through our payments and essentially record the interest revenue for every payment and the cash we received. So it would be nice if I could extend this, but I don't see how. So it's an annual bond, so most of the ones we'll look at will be semi-annual, but for review, annual works the same. It just saves a little math. So the cash received is always the coupon rate times the face value of the bond. So we have a $470,000 bond, and again, watch the rates. You want the bond rate, the 10%, not the yield. So on an annual basis, this bond is going to pay $470,000 times 10% or $47,000. So that's going to go there. My interest income is always equal to the book value of the bond times the effective rate. So in this one, because it's the first year, the book value of the bond is the 488, 280.65. And the yield or the effective rate is 9%. So times 9%. So my interest income based on that math is 43945.26. Careful with your rounding. And then the premium amortization is just the difference between those two. Right, kind of think you're making a balance. So I've got the 43 minus the 47,000 is 3054. And that's going to affect the carrying value of my bond. So it was 4882. Again, whether you add or subtract this premium or discount, I think the easiest way to remember is at the end of the bond's life, I have to be at its face value, which is 470. So I need to get from 488 to 470, so I must need to subtract. So I think it's 485, 225.91. And then I'd go on and do the same. The cash received is going to be the same every year. The interest income is always going to be the balance of the bond at the end of last year times the 9%. and then the premium amortization is just the difference. And ignoring rounding, you should get the carrying value. So I don't want to go through all the years. I think it's a good exercise for you to go through them all. Let's see if we got the first year right. Apparently not. I don't know if they want a minus on there, I'm not sure. Or if I did a typo. Let me do some math. 47,000 minus 43945.26 equals. I'm sure you guys all saw this already. Okay, and then you can just keep going down. And it's a good exercise. There will be a bond amortization question on the exam, I'm quite sure. Let's go take a quick look at the second question. Sorry, I'll walk through the rest of this. I think everything's pretty straightforward. Oops. There's the amortization table. Journal entry, record the interest rate and interest income. That should be pretty straightforward. And then for the next year, redemption of the bond at maturity. So that's really just going to be, you get the cash and the bond goes off your books for what it's on at the end of it. Straight line, if you want to go through this, straight lines mentioned in the book. We won't do straight line at all. If you want to skip it, I'll just adjust the marks. But it is interesting to go through here. This is the same number. So you will have the interest income from your effective interest rate calculation. Straight line's the same number. Okay, so that's question. The first question. The second one is a fair value question, and I don't think I want to go through this. This should be fairly straightforward. When we say adjusting entry, we are adjusting it to its fair value, so we're either going to have a gain or a loss. It's key. Dividends and other investment income are all reported in one investment income account, so that's normally what I'm going to do in class. So you don't need dividend income or gain on sale or anything. You've just got an investment income account. And we're going to sell some shares, so that's an entry you should be able to do. And then we're going to adjust whatever's left to fair value. So what it was at the end of last year to what it is this year. I don't think that one should give you any grief. It does send me a message. Thanks all.